Hi, all. This one is for my S Corp business owners and my tax pros who prepare 1120S returns. As you know, the deadline is coming up September 15th, right? For our pass-through entities, partnerships, and S Corporation. S Corporation, remember, is not a legal entity, it is a tax election. So there's some other kind of entity beneath that election, such as a single member LLC, a multi member LLC, which is different, believe it or not, than a partnership. And then you also have a C corporation that can let S Corp. So you guys know I'm always beating up S Corp. They're not my favorites for a lot of reasons. It has its place. However, I just feel some people feel it's the only tool in their arsenal. So they always pull it out and say S Corp. A lot of people are coming into the practice when I'm looking at planning, strategy, representation work, and I see the S Corp, and I'm just like, why is this person on S Corp? Either they're not making enough money to elect S Corp, because now you have an extra tax return to do that's not necessary, or you're creating more tax, believe it or not, in the space of FICA, if it's like a rental property or something like that. And now you have to pay FICA on something that otherwise you would not have. Or you are making too much money and you're still sitting on this S Corp because somebody told you that that was the best thing. So I beat it up all the time. But I'm going to show us kind of an example of one of the cases that I've gone through to show you how to analyze a return. At least this is my opinion, right? So disclaimer is, right? Do your own due diligence, do your own work. But I'm just going to show you what happened to this taxpayer, a particular S Corp. And mind you, tax reform was in 2017. So I had to amend return 18, 19, 20 because of this problem. All right. So let me share my screen and kind of give you my 2 cents. So here's my S Corp. Let's say this client comes and I'm trying to figure out, should I do a tax plan? What's worthy? So right away, I'm going to be looking at wages. I see there's none on line 7 for my compensation of officers. It doesn't mean they're not getting paid. It means it might be in this number. So I'm going to keep my eye on that as I go through the tax return. Why? Because it's a red flag, right? When you're an S Corp, you're a corporation. An officer is considered an employee. So you have to be on something called reasonable compensation. So that's my first problem. I look and I say, okay, $388,000 worth of salary to these people. I don't see anything on the rent line. This doesn't mean it's a flag. It's just things I'm thinking of because where can I save money for this client? I see this client ended up in ordinary business income of $495,000, right? I jump down to my Schedule B. Nothing really excites me there, but when I want to see the K. When I get to the K, I see charitable contributions. So I'm already keeping my mind on that. Pass-through entities cannot deduct charitable contributions on the business return. It's going to be something that's going to pass through to Schedule A of the 1040, provided that they can itemize. Okay, so there's a few things you're looking for there. So I'm just flagging it, thinking about it. My next big thing is line 16. Do I have any distributions? So I saw a pretty high wage. Maybe those officers are in there and they're getting enough money in salary, but what's going on with distribution? Did they not take anything else out, or did they take it out and not track it? Because I'm going to throw the terminology at you of basis, right? So you're going to be like, what's basis? But basis is something you should be tracking. And if the taxpayer should be tracking it, but we already know they're not, because they're going to look at you like, what's wrong with you? I don't know what that is. So it's an easy thing to just turn on in your software and track it for them. To me, that service, my opinion again, right? And then we have your Schedule L, which is your balance sheet. Got a lot of cash sitting around. That's what I know. Let me go back to this because I want to see. We have no pension, no profit sharing plan. We have no benefits. So what's going on with the people? What are they doing with their tax? So to me, this taxpayer, I see a lot of opportunity already. But this is what you're doing when you're getting ready to plan and so forth. And in my planning, I look for errors and things like that. So those are important things to point out. Got some little cost of goods sold. I don't know what. This is a service business, so I have no idea what kind of cost of goods sold. We have our K1. Look at this. I have one owner. So that tells me this owner, I can't wait to see the 1040. Where is this money going and what kind of tax are they paying? All right, there's my charity. Because as I told you, it cannot come out of the 1120F. Going to go over, OG is going to go over to the 1040 Schedule 8. I like to look at the history. I see, okay, so we started in 2018. So that tells me if I see anything coming out of that reform, it's going to affect all those prior years. This is 2020. So I'm going to go and see what else I have to do. It's just information about the thing. Here is some deductions. I see the kinds of things I kind of look through to see what are we taking. I don't see any phone. I don't see any mileage. What small business don't use their phone? Don't use their personal vehicle. So that already tells me when you're in an S Corp, you need an accountable plan, right? An accountable plan allows you to convert personal expenses into business expenses legally, right? So I'm sitting in my home office. Hey, I got to take that. But the only way to do that is to submit it on an expense reimbursement form. And then you get your tax-free money out of the business into your, all right, here's the trick. I'm tired of seeing this problem. This is my 199. Hey, I've seen this too many times this tax season. Is this is this activity a qualified trade or business? This is said, no, I'm telling you, this is this person's livelihood. This taxpayer, this owner of this business, this is their livelihood. So it is an activity qualified for trade or business. What this answer just did was kill the QBI deduction on the 1040, and you'll see that in a few minutes. And so you have to be very careful with the tax software because a lot of them default to this. I recognize this as Pro Series because I used to use Pro Series, and I know how it looks, and I know that this is a default. And if you don't have this in your checklist when you're reviewing a tax return, you're going to have this kind of a problem, or, you might forget to check because I do know, when I get on the phone with a lot of the preparers, like, for example, when I'm doing the plan, but they're keeping their tax preparer, and I bring this to the attention of the business owner, we often jump on the call with the practitioner so that we can share and say, hey, what were you thinking? And almost always they're shocked. They're like, oh my God, this is my passive. And so, yeah. If somebody doesn't point it out, those things happen. So anyway, I'm looking through this. I'm looking for contracting expense. Here's outside services, because then I'm going to ask the question, did you issue 1099s? S Corps are full of fringe benefit rules. So that's another reason why I look for pension, IRAs, health insurance, because there are certain ways that you deduct these things. In some instances, you're considered self-employed. In other instances, you're not. And so there are plenty of rules around these S corporations. So I just wanted to show you those. And then we're going to jump into the 1040. So I like it already. I got a business and I'm married. So I'm going to look for opportunities to hire my spouse. Then I'm going to look for opportunities to hire my dependent. So this one is below 18. I know that because we got a child tax credit over here versus the other dependent credit. So that means I'm going to find out the age and I'm going to see, can I hire this child? Because, well, this is back in 2020. The standard deduction was $12,400. So I can pay my dependent up to that amount tax-free. So that's money, a deduction out of my business, right? I can pay, but guess what? It has to be a legitimate task. You have to treat this child arm's length as you would an employee, have a job description, a rate of pay, those types of things. But the point is, if this child were to get a W-2 with this amount on it, by the time they take the standard deduction, they'll have zero tax due. That's why we like this strategy. And I'm sure we can find I'm not going to lie, it's hard to get teenagers to work, okay? But you can entice them by saying, you want to go to the prom, you want that coaching, you want to take piano lessons, whatever, you got to work for it. Start small, a couple $100, and build up. They'll like the reward feeling. And I just think it works because it works with my kids. So when I'm doing a tax plan, I'm looking for ways to lower income, increase deductions, and increase credit. those are the ways I'm going to look for opportunities to lower my client's tax liability. So as I look at this, I'm seeing a high wage. And I'm going to tell you, this is huge, right? Let's cheat and jump to the W-2 scenario. This 320, that tells me the majority of that 388 we saw on the 1120S belongs to my taxpayers. That tells me they're overpaid and they're paying too much FICA. And usually, and the spouse is in the business too. So not an owner, but an employee. But if I were to hire this employee on a Schedule C, like in a family management LLC, I'm going to lower FICA because right now they're overpaying FICA. And, it's another story, another session to get into to show you how and all of that. Because I could virtually pay this spouse in tax-free benefit and lower this wage, lower the wage, lower the FICA, Social Security and Medicare is where I'm going with. So that's what this is telling me. A little bit of investments. Okay, no problem. It's kind of small. So I don't feel like over the top about that yet, but I'm going to come back to that. So that makes so that's my wage. But then here's the other income, right? It's coming over from that 1120F, 495,020. So did I mess that up? Let's make it nice and neat. And here we go. Right? So look at this. Look at my total income. Look at this itty bitty, teeny, weeny charitable deduction. Because this is a COVID year, the IRS threw us a bone and said, hey, you can take at least $300. I believe merit filing joint is $600, but they may have done that in 2021 only, but whatever. My point is, these clients, these taxpayers, their standard deduction is $24,800. So let me refresh your memory. They gave to charity $20,100 and they can't even deduct it because they can't itemize. In the IRS's eyes, that's sitting in this number, which is crazy because at this wage they're paying, oh no, so I remember they're a tax-free state, but still they have SALT limitations, right? So if this was a client in an income tax state, that's limited also. So my point is this 24,800 killed it. The reform killed that deduction. I could think of plenty of things to do with this. Like I just did a video on leveraged charitable deduction. If they put that amount into that leveraged charitable deduction, they would have gotten 4 times that to put on Schedule A. And so they're limited. But here's my other problem. Here's my QBI. Hey, I'm in a pass-through entity. Why don't I have QBI? Whoever did this tax return for this taxpayer, I'm trying to find which it was on the K1. They said they didn't materially participate. So it made it passive. And even uglier to add to the mix, well, let's keep going because I just get too excited. It just annoys me. And I see this. I've seen this several times this tax season. I'm not making it up. This is real life stuff. My client has taxable income of $790. The tax due on that is $229,000. It withheld $46,000 federal tax out of the W-2 wage. Here's this other tax. So right away, my head is like, okay, on top of that, they got to pay this. It's not self-employment tax. So in my head, I'm like, it's not self-employment tax because they already have wage. They're not on a Schedule C. So what is this other tax? Already my brain is working. Look at these people. They paid estimated tax payments of $215,000. It's too much. You give the IRS all of this money and then you're getting, in this case, they're lucky they're getting a refund of $14,559. They overpaid by this much. This money could be working, doing something else. I don't like occupation entrepreneur. I say what you do, okay? Because entrepreneur is fishy. I don't know. It's too. The IRS doesn't do anything with this, but if you're audited, they're looking for ordinary and necessary expenses related to your occupation. So entrepreneur is too broad. So say something more specific if you can. By the way, this was prepared by a credentialed tax professional called an enrolled agent, which is fine. I like that. I like a professional doing it, but you can see that the person made a mistake. On Schedule 1, it's going to bring over that Schedule E is coming forward. See, coming from the Schedule E, the income from the S corporation. Then I see all these blank lines, my adjustments. I have no HSA, no SEP IRA, no health insurance deduction. Did we miss it? Did they have it? Should we suggest it? I don't know. So there are a lot of things going on here, an opportunity for tax savings. Let's look at Schedule 2. Okay, so now here's this additional tax that these people paid from the Form 8959 and 8960. So I'm curious. I want to get rid of that tax if I can. I go down to Schedule 2. Okay, so they're high income earners, so they're gonna pay. So they overpaid. This is Schedule 3's additional credits. They overpaid Social Security again. I told you if one of the spouses reported to the other, we could save on some of that. Here's the passive I told you about, 8959. So when you're the high wage earner, Medicare is unlimited. So there's an additional 653 from Medicare, which is fine. But here's the kicker. They paid net investment income tax needs, right, of $18,840. Let me tell you, when I had the discussion with this taxpayer, the husband almost fell off his chair. They overpaid taxes by so much. They're missing their QBI. Plus, because the income is passive, right, they have to pay this kind of tax. So this is dollar for dollar money back in their pocket. It's worthy of an amendment, I'd say. Okay, so those are the major things I wanted to show you on this, looking out on reviewing returns and making sure that you understand what your tax pro is doing for you. And for tax pros, make sure you're reviewing properly. Now, I told you about the wage. I think the wage is too high. There's savings immediately off the bat when you do reasonable comp analysis. I can go on and on about this stuff, but the S Corp, it's there. I'm curious if these people have basis. As I mentioned, if they have basis, that wage can be reduced, right? And take a reasonable compensation and take the rest out in tax-free distributions. I hope that makes sense. Talk soon.